Imagine you're standing at an airport in London. You've just landed from New York. You walk up to a coffee shop and you see a simple latte costs £5. You reach into your wallet, pull out a 5-cent piece from back home, and the cashier just looks at you and shakes her head. Now think about that. Both are small pieces of metal. Both were minted by a powerful government. Both represent money. So why does the world treat one like gold and the other like a shiny button? Why is it that $1 can buy you a feast in one country, but won't even buy you a stick of gum in another? Most people think the value of money is fixed, like the length of a meter or the weight of a kilogram. But it isn't. Money is alive. And today, we're going to look under the hood to see what actually moves the needle. Part 1. The Myth of the Gold Standard. Let's start with a history lesson. A long time ago, money was simple. You had a piece of paper, and that paper was a receipt for a physical chunk of gold sitting in a vault. If you had more gold, your currency was worth more. But in 1971, the world changed. Most countries moved to something called fiat currency. Fiat is Latin for "let it be done." Essentially, your money has value today not because of gold, but because the government says it does. It's backed by trust. And as we know in life, trust is a very, very fragile thing. Part 2. The Law of the Playground. Supply and Demand. Think of a currency like a rare trading card on a school playground. If everyone has the same card, nobody wants to trade much for it. It's cheap. But if there is only one card in the whole school and everyone needs it to play the game, the value skyrockets. Currency works the exact same way. If a central bank prints too much money, flooding the playground, the value of each individual note drops. This is why some currencies have so many zeros on them. They printed so much that a single note became almost meaningless. Part 3. The Interest Rate Magnet. Now, why would an investor in Tokyo want to buy US dollars instead of Japanese yen? It usually comes down to rent. We call this rent interest rates. If the US central bank raises interest rates to 5%, but Europe stays at 1%, where are you going to put your savings? You go where the money grows. Global investors rush to buy the currency that pays the highest rent. This massive rush to buy increases the demand, and just like that, the currency becomes stronger. Part 4. The Shopping Basket Comparison, PPP. Economists have a funny way of measuring value called purchasing power parity. You might know it as the Big Mac Index. Think about it. A Big Mac is the same burger everywhere. Same bun, same beef. If a burger costs $5 in New York, but the equivalent of $2 in India, it tells us something profound. It tells us the Indian rupee is undervalued. It means your dollar has more muscle in one place than another because the local cost of living hasn't caught up to the global exchange rate. Part 5. Trade Balance, the Vending Machine Effect. Imagine a country is like a giant vending machine. If the world wants to buy what's inside, German cars, American software, Chinese electronics, they must use that country's currency to pay for it. When a country exports more than it imports, everyone is constantly buying their currency to pay the bills. This keeps the value high. But if a country only buys from others and sells nothing, they're constantly dumping their own money onto the global market. And what happens when you dump too much of something? The price falls. Part 6. The Safe Haven Psychology. In times of war or global panic, something strange happens. Logic goes out the window, and fear takes over. Investors stop looking for the most profit and start looking for the safest bunker. Usually, that bunker is the US dollar or the Swiss franc. Even if the US economy is struggling, the world trusts its legal system and its military. This safe haven status acts like a permanent floor for the currency's value. People buy it because they believe it's the last thing that will ever fail. Part 7. Inflation, the Silent Thief. Inflation is like a slow leak in a tire.
If your prices in your country are rising by 10% every year, but prices in a neighboring country are stable, your currency is losing its buying power. Foreigners don't want to hold a currency that is melting in their pockets. They will trade it for a harder currency that holds its shape. This is why countries with high inflation almost always see their exchange rates collapse. Part 8. Geopolitics and the oil factor. Finally, we have to talk about power. For decades, most of the world's oil has been traded exclusively in US dollars. Think about the leverage that gives. If every country on Earth needs oil to run their factories, and they need dollars to buy that oil, they're forced to keep a stockpile of dollars. This creates a forced demand that keeps a currency strong, regardless of what's happening in the local economy. It's not just economics, it's diplomacy. The recap. So what did we learn today? We learned that different currencies have different values because they aren't just paper. There are reflections of a nation's health, trust, and power. We saw how interest rates act as a magnet, how trade acts as a vending machine, and how inflation acts as a thief. The next time you see those flickering numbers on a currency exchange board at the airport, remember, you're not just looking at prices, you're looking at the heartbeat of the global struggle for stability. Class dismissed.